A disturbing report has emerged from Westminster, shedding light on the UK's financial state, an issue most politicians avoid discussing. This goes beyond tax increases and budget cuts. It's a stark warning about the very survival of the British economy. Between 2000 and March 2023, the UK's public sector net debt, excluding the Bank of England, tripled, now hovering around 100% of GDP. This explosion in debt stems largely from the government's responses to the 2008 financial crash, the COVID-19 pandemic, and the recent energy crisis. Historically, such levels of debt have only been reached during wartime. Yet despite the alarming figures, political discourse has remained eerily quiet. Major parties seem unwilling to confront the full implications of this mounting burden. An urgent inquiry. In response, the House of Lords Economic Affairs Committee launched a comprehensive inquiry into the sustainability of Britain's debt. For them, debt sustainability isn't just about how large the debt is. It's about whether the country can realistically pay it off, given its economic growth and borrowing costs. The committee's findings are sobering. Without decisive fiscal reforms, the UK's debt could soon spiral out of control. In short, the government faces a harsh reality: either increase taxes or dramatically reduce the scope of public services. Business as usual is no longer an option. There are several pressing reasons for concern. Reversing trends. The economic patterns that once helped manage debt are now working against us. The UK faces what the committee calls the 5 Ds: higher defense spending, demographic shifts like an aging population, the costs of decarbonization, a growing number of economically inactive workers, and rising debt interest payments. Weak growth. Economic growth is stagnating while real interest rates now exceed GDP growth. This imbalance makes it nearly impossible to stabilize debt without creating budget surpluses, a goal that seems increasingly unrealistic. Risky debt structure. Successive rounds of quantitative easing have left the UK with more short-term inflation-linked debt. This exposes the nation to sharp increases in borrowing costs and makes it highly sensitive to changes in investor confidence. Ineffective fiscal rules. Current debt targets are constantly revised, masking the true scale of the crisis. No matter how the government redefines its benchmarks, the underlying problem remains. Debt levels are dangerously high. Hard questions for the government. Tax revenues as a share of GDP are already at record highs, and public debt is back to levels not seen since the 1960s. Yet growth projections have been significantly downgraded. If the most recent budget was meant to place public finances on solid footing, why was it reworked just 131 days later? If it was meant to fuel growth, why is the economy still struggling? And if taxes are already this high, can citizens expect even more increases? Until these questions are faced with honesty and urgency, Britain risks drifting unprepared toward a full-scale economic crisis.